Well, it's been a couple trading sessions since we saw mortgage rates go down. So what's happening today in the markets? Well, the biggest news out there right now is the new beautiful tax bill just passed. That's giving a lot of kudos to the markets, but unfortunately the bond market doesn't like this, and I'm going to explain the whys behind it on why this might not be a good catalyst when it comes to interest rates. So let's get over to it. My name is Dan Frio. I actually do this report 2 times a day to inform you guys what the heck's going on with these things over here, and the reason being is I'm a federally licensed loan officer. I work at a federal bank, and I'd love to win your business because I'm licensed in all 50 states as well as Puerto Rico. Our slogan here is one application, one credit pool. We're going to shop your rate to over 30 different lenders. Now, how do we do that? I'll give you all that information at the end of this video. You're here to figure out what's going on with these things over here. So let's get to it. We had just now as the House passed the president's big, beautiful tax bill, and it's going on to the Senate to get signed. It'll probably get signed off, but the markets that hate this is basically the bond market. And why? Let's get over to it. Why the bond market doesn't like this is it's saying it's going to add more debt to our national deficit that's already bloated. So how does that hurt us? Well, it's going to cause more supply, and we're all into supply and demand. So if you have much more supply of a bond, could be a Treasury bond like this, or it could be a mortgage bond like this. If there's more supply and less buyers, what's that going to do to the price? Well, it's going to bring the prices down because it's going to cause, or prices up. It's going to cause prices to go down because it's going to need to attract buyers. Well, what do we know when prices go down on bonds? Well, the rates go up. That's that yin-yang effect that we talk about. So if the price of this thing goes down, yields go up. Well, here's the problem right now that people are also facing with a lot of this stuff and a lot of tariff things. They're saying, okay, maybe now a lot of bond investors aren't going to invest in the U.S. Maybe they're going to go elsewhere. And that elsewhere now that's hitting the market is Japan. So Japan's bond market is skyrocketing right now with really high yields. So now investors are saying, okay, are investors now going to move their money over to Japan's bond market? And that's causing more uncertainty to the U.S. bond market. Well, to understand a little bit more about this and how it works, let's get over to Rick Santelli at CNBC. He's going to explain this to you. Then we come back, I'll break it down in a little more detail so you can understand it. So Rick, take it away for us, buddy.
Bond report, but maybe we should call it the yield report. Because, Rick, I think this is a massive story, not just here, but globally, maybe one that we're downplaying a little bit, I think.
I disagree.
Okay.
I disagree. First of all, there's a reason that 10 years are the benchmark, okay? 10 years are the benchmark because does anybody realize that we didn't even have issuance of a 30-year bond from 2001 to 2005? They stopped issuing them, and then they brought them back. So the 10-year has been the benchmark for decades. And all of a sudden, everybody's switching gears. And remember, the 30-year in Japan is going wild because much of the 10-year was manipulated. They wouldn't allow it to go higher. So, I want to get to some of these charts, Brian. So if you're in the control room, forget the first few charts. Here's the chart I want to go to. I want to go to the last 2 charts, okay? Last 2 charts. Here's a chart of the 10-year JGB for 2 months. The high yield there, today the close was 156. It is under where it was just 2 months ago. Now, here's the one I love the best. Everybody's showing the 30-year bond of Japan at 315 because it's never been there. Let's look at a 10-year note going all the way back to 1989. Does this strike any fear in your heart? Nope. Sorry, it doesn't. In my opinion, interest rates have been going up for a reason. Debt and deficits. I was screaming about it for years. People are paying more attention now. And even though that may be seated in politics, I don't care. But the notion to make story that what we're doing right now is somehow out of the ordinary makes no sense. The average yield of a 10-year note is significantly higher than people think. It's in the 4s. So I don't see anything unusual here, except for the fact that all of a sudden we're showing 30-year charts that we haven't shown to this extreme in many, many years.
He's right on point. So what he's saying is we have to really pay attention to bond yields and bond yields everywhere. But a lot of investors are now coming in, or Wall Street people are coming in saying, well, the yields over in Japan are really high right now. Let's start taking our money and not investing in the U.S. and moving it over there because those yields are so high. We still have higher yields in the U.S., and we still have much more security in the U.S. than there is basically anywhere else in the world as well. So that's what he just wanted to make a point, that a lot of people now all of a sudden are worried about the deficit, and you wonder why. And I've been screaming about it, as Rick's been screaming about it for years. And so a lot of people, they come back to me on the student loan debt and all this other stuff. Yes, I'm against a lot of this stuff because I want our national deficit to come down, because in a roundabout way, it's going to help all these things. How? Well, let's break it down. So the less debt that we have to issue as a country, and that's what the Trump administration is trying to do right now, create less of this. What it's going to do is, if you have less of something in the market, of something that's valuable, well, what happens to it? Well, the prices are going to go up because people are going to be attracted to it when there's not a glut of it like we have today. So if we have less of a supply, a good yield, and a solid backing of these bonds, investors are going to flock to it. Okay, so what they're trying to do right now is bring down the 10-year Treasury. That'll be the next focal point for the Trump administration. You're not going to hear anything about the 30-year bond because it really wasn't a thing, and it's not going to be a long-term thing. People are going to focus in on the 10-year Treasury, and that's the why is behind it. So the hope is there's less debt out there from our nation, thus causing yields to come down that point. So the Japan, you might start hearing things about the Japan bond yields skyrocketing and so forth. Well, you got the news right here first, because you probably hear this first before you hit it on mainstream. So that's what we're seeing right through there. So bond yields, the bond market is basically what creates mortgage rates. Okay, this bond right through here, it's the MBS. It's a mortgage-backed security bond. This bond trades on Wall Street. And the yield on this thing is the biggest component of your mortgage rate. So we take the yield on this, we take what's called LLPAs, those are called loan level price adjustments. And those are things like, if your credit score is lower, you're going to have a higher rate. If you're buying a condo or a 4-unit building, well, the rate's going to be a little bit higher than if you were buying a single family home. It's just how those work. If you have a higher debt ratio, it might affect some things. Things like that are loan level price adjustments. So you have bond yield, loan level price adjustments, plus the bank's profit margin equals your mortgage rate, where it comes right through here. So that's how all that works, and that's why we're so concerned about the bond market on this channel. Now let's go over to what's coming in tomorrow when it comes to the news. The only thing coming out tomorrow is new home sales, and initial existing home sales were the worst sales numbers since 2009. So I'll say it once again, folks. I called that the housing market was going to be completely flat in price-wise. Unit-wise, I pretty much knew that there weren't going to be a bunch of units being sold. That's where a lot of people didn't do their homework. So if you don't have a lot of houses for sale, the house prices aren't really going to go anywhere. But right now, people are really reluctant. They're just waiting on the sidelines, and I can vouch for it. We have hundreds of people sitting on the sidelines just waiting for interest rates to come down just about 0.5%, and then that'll open up the flood markets. But until then, we're just going to sit and wait and see what happens between tariffs, this tax situation, and basically all the world events out there. The next thing I want to talk to you guys, before you go out there and apply for a mortgage, you need to go to optoutprescreen.com. Okay, what this does for you, and this is my public service announcement, you're going to get probably 30 to 50 phone calls if you go into a bank and you apply for a mortgage and they pull your credit. Okay, it's just how it works. It's called trigger leads. If you want to stop those, go to optoutprescreen.com, and you can do that right there. You're just going to scroll down, fill out a few things, and it's nothing I created. This is a public service announcement that I'm doing to help those out there that are looking for a mortgage. I'm helping you hopefully not get about 30 to 50 phone calls from solicitors. Now on to me, who I am, and what do I do? So my name is Dan Frio. I'm a federally licensed mortgage loan officer. I work at a federal bank. Yes, I do. And that gives me a license through all 50 states as well as Puerto Rico. And the unique thing about us is I have that slogan out there, one application, one credit pool. We're going to shop your loan to over 30 lenders. How does that work? It's pretty simple. Because I work at a federal bank, as a bank, we set up 33 other lenders with us. So when you apply through here, what we're going to do is we're going to analyze your loan and we're going to see, can we do it? Or couldn't any of the 33 other lenders do it for us? Okay, we can get you that program. And then also, what are you looking for when you're calling out there to all these lenders? You're trying to get that the best rate in the market at the lowest fees. That's another area where we can help you. When we scan all these, not only do I offer you their rates, there was most likely no fees involved in this for our transaction. So thanks for watching, folks. If you want to find out more about that and how we shop around, go to therateupdate.com. You can put in your application right above my head. You can put in a consultation call right through here. You can call me at the 844 number right there, or you can scroll down here. And also, before you go away, check out some of these other videos that we have on our YouTube channel. If you're out there and you're a homeowner right now, check out the RateWatch tool that we have. You're going to put in your information and don't miss out on that rate. When interest rates come down, we'll be able to tag it and make sure you get alerted when those rates hit exactly where you want it to be. If you're looking to buy that first house, maybe check out this video right here. FHA loan programs, any new data out there on that? We'll check out this. And there's even a credit, understanding your credit video down here as well. So you can check out these and over 3,000 videos on our YouTube channel. So thanks for watching, guys. God bless. Have a fantastic evening. I'll see you back here tomorrow. Take care. Bye-bye.